Hey everyone, just wanted to do a quick video on minimum liquidity covenants to really discuss why they're there, typical situations where you'll see them, and why a bank would want a client to keep cash balances on their balance sheet even though they're properly collateralized with the facility. So let's get into it. And this is, I would argue, 95% of the time, the reason why you would have a minimum liquidity covenant. It's when a line of credit is present in a business that is very inventory reliant. The business is more mature, and the owner doesn't want to personally guarantee. So, for this example, let's say that the client is in the steel industry. They produce steel. And so, what typically happens or can happen in the steel business is there can be a large inventory write down because there's too much steel in the market, the economy slows down, and this inventory that I have marked here at 2.4 million and the collateral advance rate is 50%. So the amount of collateral used to support this $2 million line is 1.2 million. This collateral can get very steeply discounted, and the bank won't like that. And again, too, a lot of what dictates or drives these minimum liquidity covenants is the owner doesn't want to personally guarantee. And so the owner will say, "That's fine. I I don't want to personally guarantee, so I'll keep some level of cash balances on the balance sheet, but then anything above that amount of cash balances within reason and within my other covenant structure, I'm going to distribute out." And a lot of the times, too, with these situations, as you'll quickly see, the client won't necessarily even have a debt service coverage or fixed charge coverage covenant that is really monitoring the distributions, the money out, as long as they maintain this minimum liquidity covenant. So let's just work through this example real quick, and I think you'll understand what we're getting at. So we have a line of credit. The line of credit is $2 million, and as you see here from this line balance, the line of credit is collateralized by $1 million in accounts receivable on the balance sheet, and that's the advance rate on that is 80%. So there you get 800,000. And then inventory, they have 2.4 million in inventory at 50%. So you get 1.2 million. And that gives you your total collateral pool of 2 million. And again, too, there's no personal guarantee. So this needs to line up on a one-to-one basis. So then the bank will look at this and they'll go, okay, this is steel that's already been sold, this accounts receivable. We know the client's customers, they're good customers. And we also understand too that in a distressed scenario, the client might not be able to get 50% for their steel, but they can get 25% for their steel. So, uh, we're okay with not having a minimum liquidity or minimum liquidity covenant of the total line amount, but in order to get us more comfortable and to make sure that we're okay with doing the lack of a guarantee, we're going to say that you need to keep 1.2 million in cash balances on the balance sheet in order to support the inventory reliance of this line, and then also too to have a little bit more cushion to support the lack of a guarantee, because really at the end of the day, it's the steel business. The bank doesn't know anything about the steel business, and you really need a guarantor to come in and work this inventory out and collect the receivables in order to pay down the line fully. So instead of having a personal guarantee, you have a little bit of extra cushion in here to make sure that the total line gets paid down. And that's really all it is. It's a very simple covenant. It's almost like buying yourself out of a guarantee. And again, this is usually in inventory reliant businesses where you typically have ownership on personally guaranteeing the facility due to the industry and other nuances of the relationship. And the bank is asking the ownership to keep the cash balances in order to get them comfortable releasing the guarantee. And again, this is a mature situation. So, hope this example provided a good understanding and good breakdown of where you typically see these situations, why the bank would ask for them, And also, too, if you want to take your personal guarantee off a facility, maybe something that you can propose to your bank. So, thanks again for listening, and I will come with more covenant videos.